Good afternoon, everyone. Welcome to this rundown for global stocks for the 22nd of May. And we had a week where there wasn't a lot of movement, but we certainly saw probably the start of a correction in gold, which occurred on Wednesday night. But I've got to say that the follow through on Thursday and Friday was almost non-existent, and gold and gold stocks remain very, very impressive considering the circumstances that applied over the last 48 hours. So we'll take a look at that and the rest of the market. So we'll start, first of all, in every few weeks, I like to present you with a bit of a bigger picture of appraisal of what's going on, because it's very easy to get too close to the day-to-day and week-to-week changes in financial markets. And I think quite regularly, and this is what I do, pretty much every week, quite regularly we need to step back and look at the bigger picture so that we've got really a sharp view on what's going on. So I've got several slides here which I think are really important and really illustrate the bigger picture position that we're in at the moment. So as I've been saying now for a long period of time, and of course many others are as well, is that central banks really have appear to have lost the plot. It almost seems now by their policy announcements that they're actually being driven by markets rather than formulating policy, and markets follow central bank policy. It seems as though that's flipped around the other way. And they've just made a series of, I think, what will prove to be disastrous policy errors. And the outcome of that, this is in my view, in the view of a lot of other people, I just can't see any way that this is not all going to end very badly, and that they've caused an irrevocable, irreversible distortion of financial markets that now things can't be put back the way that they were. Now, the only thing that I don't, and I'm pretty comfortable in that view, the only thing that I don't know is what will be the time period over which things will get significantly worse. Could be a matter of weeks or months, if a few triggers actually occur in the next little period, or it could be many years. I don't think it's helpful to actually try and predict or have an opinion, because what it does is it colours your thinking, and that prevents you from perhaps seeing things that you would otherwise see. So I'm not saying that this is imminent. I just believe it is virtually inevitable. There are a lot of triggers lining up at the moment. We've got the vote on whether Britain stays in the Eurozone on the 23rd of June. We've got all sorts of issues potentially in China, in Japan, in Europe with Greece, with Italy. It's in South America with Venezuela. It's just, there's potential problems everywhere, but at this stage they remain just potential problems, and at the moment the market seems to be reasonably sanguine to all of those possibilities. But I believe that the various federal reserves and the ECB and the Bank of Japan have painted themselves into a corner, and there is no way to go, and I'll get to that in a slide or two. So I think inevitably, and again, this is big picture, so this won't happen necessarily in the next few weeks, but I think this will play out in the not too distant future, is that inevitably central banks have got a choice. They're either going to have to choose to defend their currencies, and the only way they're going to defend their currencies is to raise interest rates. And I think it's not going to take very much in the way of a rise in interest rates to collapse the bond markets, and that will be like 2008 revisited. So I'm kind of doubtful that they're likely to go down that track. But the other alternative choice is to try and save their banks, which is of course what they did in 2008. And they do that by printing more artificial money, and the outcome of that is that currencies are devalued. So they're taking away the purchasing power of citizens all around the world. I think it's likely they'll go for the second one, because that's what they've done before, and that's probably the more politically acceptable one. But I think inevitably that's the choice that will face central banks. Uh, Here's a little cartoon which I thought was incredibly appropriate. Janet Yellen, Mario Draghi, and Kuroda from the Bank of Japan having very neatly painted themselves into a corner because they appear to have a lose-lose choice in this matter. There really isn't a winning outcome out of this. So continuing on, the inevitable outcomes for me is that there will be a rapidly accelerating accumulation of gold. I find it hard to believe that that won't occur. Now, the movements in precious metals are very volatile, so I don't think this will be smooth sailing because it won't. But I think that is a trend that's well and truly underway. I expect that we'll see some severe financial system difficulties, especially in Europe and especially in Italy. It's not getting much coverage at the moment, but Italy's in such a precarious position and there's such a large economy. It's going to absolutely dwarf the consequences of anything that happened with Greece or with Spain or with Ireland. So very little being said about that at the moment, but I think that's probably keeping central bankers awake at the moment. Now, again, let me reiterate, I'm not predicting anything. I'm not saying within what sort of time frame. I just think these outcomes are inevitable. And the other quite possible outcome is a period of stagflation like we saw in the 1970s, and that was horrific. We certainly don't want to go back there again, but it's a distinct possibility. And stagflation is the worst of all outcomes. If you're not sure what that is, it's basically the price of goods and services rising, the price of assets, as in shares and property and bonds, falling, and a very large spike in interest rates. And whenever we've had those sort of circumstances, stock markets tend to fall by a considerable margin. And, I'm talking 30 to 50% kind of margin. So that would not be pleasant. And of course, that means significantly lower purchasing power. So I raise this for two reasons. One, I don't think anyone should go into the next 5 years or so blind to what's going on. And yet at the moment, if you're just looking at the stock market, it would appear to be business as usual. And there's certainly not very much in the mainstream media about this. And so that means that people aren't getting themselves prepared for what I believe is inevitable outcomes. And that's incredibly dangerous. The second reason that I raise it is because it's just such an integral part of how you should approach your trading and investing. And to not be aware of potentially what's happening, I think is incredibly dangerous to your financial future. So what action should we take now? I've thought long and hard about this because I could probably put up 20 points about things that we could do, but I tried to distill it down to the couple of things that I think are the most important big picture things that you should do. And the first one is to just remain very open-minded to contrarian thinking. Question everything in conventional wisdom. Don't accept anything at all. There's a lot of discussion at the moment going on about, well, if the US dollar rises or falls, then this will be the outcome with respect to commodities or stocks. That may happen, but a lot of it is based on pure perception and not facts. The facts are that we've seen significant rises in oil and gold at the same time that the US dollar has been rising. And yet mainstream thinking would tell you that if the US dollar rises from here, that oil and gold are going to go down, that it's a given. And I can tell you that if you look factually at history, it is not a given by any stretch of the imagination at all. So question every bit of conventional wisdom. Don't get stuck on relationships that have been in the past. The second thing is to follow the strongest trends in the market, even if they seem illogical to you, because it's just so important these days to go with what is and not what you think should be. And I've said that repeatedly over the last few months. Looking at technical analysis, in my view, is far more important than fundamental analysis these days. And if you're not doing it at least as well as fundamental analysis, then you're treading on very dangerous ground. The third point is to be sufficiently patient and that's not easy, but be patient and wait for new unfolding trends, and then have the courage to act on those new unfolding trends, because that is the most straightforward way to generate strong, low risk returns. You get in on the start of major trends that are going to run for years. We've seen a 3 or 4 year trend in biotechnology stocks in America that saw 400% gains. Every precious metals bull market that we've seen over the last 30 or 40 years has run for at least 2 to 3 years, and sometimes far longer, and generally goes at least 300 or 400%. That's the reality. So if you can be patient enough to wait for those really big picture trends and be prepared to get in somewhere near the start, you don't have to get in at the bottom, just somewhere near in the first few months of the start, then that is the most straightforward way for you to really build wealth. And of course, precious metals, for all sorts of reasons, is a really important part of any portfolio at the moment. So just to finish off on the big picture, and then I'll get on to markets. I'm labouring the point, but I just think this is just such important concepts to get your head around. There is a lot of danger in perception. Human beings tend to look backwards and assume that what has been will continue. That's just the way that we're made up. It's a natural thing to do. And that's why so many analysts today have still got sell signals on gold stocks, and have from the start, because they're looking backwards. They're looking at a 4-year bear market. And the second thing, that we tend to underestimate how far and how long a new trend will run. And I get to talk to a lot of people, and I get a lot of questions from members and from non-members. So, I know how people think, and I've been doing this for nearly 15 years. Just consider what has happened with gold stocks this year since the bottom in January, after a 4-year bear market. Now, as I said, lots of analysts are still, no one's talking about gold. You won't find any reference to gold in the Financial Review. Most brokers have got sell recommendations on gold stocks. And no one's really in the mainstream is talking positively about gold. And so what I've been hearing are questions like, gold stocks have gone up 100%, I've probably missed the boat. My answer to that is that, not at all. We've seen just the first little bit of a multi-year bull market, and that missing the first few months can actually be an advantage. And the reason I say that is because if you miss the first few months, yes, gold stocks have doubled in that period of time, but you are then you've got a much higher probability that this is developing into a new uptrend and not just some little blip in a downtrend. So don't worry at all about missing the first little bit. All right, there's those opening remarks. I think they're really important, and I hope you take them on board. Let's turn to the American market now. The S&P was higher by 6 points for the week, but look, it's just more of the same that we've seen now for some time. Medium-term direction remains inconclusive. We've got economic and corporate news in America, economic news from around the world, and it's just a complete bag of mixed signals. So the bears seize on the negatives, the bulls seize on the positives. And, in my view, neither of them are right, because we don't have enough evidence. We've got a possible June rate hike by the Federal Reserve. That's a real wild card. We saw how markets reacted in January after the Fed raised interest rates in December. There's every reason to suspect that markets will probably react the same way if they actually get around to doing it. The Aussie dollar had a big fall the week before, fell a little bit further, got down to 71.8, finished the week at 72 and a bit. And I think we're seeing a probable major change in the US dollar. And I want to have a good look at that US dollar chart. And the 92 level on the US dollar index is really, really important. So if we are starting to move back up again, then that's going to be good for a lower Aussie currency. So if you've got money overseas in US dollars, then that's going to be a bit of a tailwind for you. Now, the response from stocks and commodity prices is not often logical. As I spoke about before, there are plenty of periods in history where gold and oil have gone in the same direction as the US dollar, which would appear to be illogical, but it happens anyway. So don't get too caught up in what you think should be. The ASX index was up by another 22 points on the week, but in our market, that's not very much, and there's very, very little in the top 200 that's trending. So let's take a look at some charts. We'll start with the S&P index, and I've panned back for a very big picture look. We'll go back even further. So this is back to the bottom in 2009, and then we've got this correction here in 2011, which was the last time that we had a decent pullback. You can see this time round, the pullback hasn't been able to make it back to that long-term trend line. And it's not to say that it will necessarily get there this time either, but just to give you a big picture view of where markets could go. So if we did get a retracement over coming months back to that long-term trend line, then we could be back down testing the 1800 levels again, and on a very big picture level, the 38.2% retracement of this whole move from the GFC would bring us down back down to around 1728. That's all very big picture stuff. You can see here that quite clearly the character of the S&P index has changed. The red 200-day moving average has clearly rolled over, and prices are doing something that they hadn't done for the previous 4 years. So there's no argument that the character of the market has changed. The only question is where to from here. Is this a big consolidation that might rumble on for the rest of the year and then eventually we break into a new bull market? Or is it appropriate to get a bigger picture correction of that whole move? I think the answer to that really lies very much in whether any of the triggers get fired or not. Does Britain leave the Eurozone? Does the Fed raise interest rates? Does the Japanese economy, some sort of explosion occur there? Or all those sort of things. Is there a breakout in inflation that people have been calling for many years? I don't know. We'll have to wait and see. But at the moment, the market is not really showing us very much at all. I've got a little support line through here, which I think would be that's a key line in the sand at around about 2022. I could have put it a little bit higher up here at about 2035, but you get the point. We're very close to a little short-term ledge. I think a break of that would see a retracement of certainly this run, and that could bring us back then to somewhere around about the 1995 mark, or possibly even 1960. So if this level here breaks, then look for those levels. 1960 would be the levels. Turning now to let's look at the US dollar index. This is important. So big picture, you can see we've had a massive rise, which came off this base here at about 79. If we go back further, this 92 level, where it's at the moment, has been a really important fulcrum point for a long period of time. It bounced off it back here in 2003. We spent some time around there in late 2003. There were peaks here in 04 and 05. And again, it's provided support a couple of times just recently in the last 12 months. So this 92 level is critical. Now, you'll notice that we got a little false break on the 3rd of May. But that turned out to be a false break. We dipped under it intraday, but then had a complete reversal of sentiment on that day. And you can see since then the US dollar has gone up very, very sharply. So, and that turnaround actually occurred before the Fed started putting a bit of chatter out in the marketplace that that they may raise interest rates in June. A lot of people are just saying that it's purely because of what the Fed said through the week, but that's not the case. That reversal actually occurred a few days before that. So if this is going to trend back up to the upside and possibly even break 100, then that is highly significant for both stocks and commodities. So very, very important. The Australian dollar rose very sharply, has come back very sharply, but you can see still remains within this overall downtrend. And if the US dollar is going to keep rising, then the possibility of us revisiting the bottom of that channel, which would bring us down at the moment, the bottom of that channel would be somewhere down around 65, 66. So that could bake in some significant gains if you've got money overseas in US dollars. Turning now to the ASX 200, just for the record, you can see there has really done very little in the last week or so, but probably in the short term outperforming the S&P. So that's maybe a bit of an indication about the relationship with commodity prices. Now turning to precious metals, gold and silver was slightly lower for the week. The short-term trend in the metals and in the stocks looks quite wobbly. As I said in my special update through the week, that it looked very much like we were going into a corrective phase, and that is still quite likely. However, the moves on Thursday and Friday were extraordinarily positive, considering that the price of metals went down. Generally after a day where prices of stocks fall by between 5 and 10%, which is what happened on Wednesday night. Normally there's some very strong follow through to that. That didn't occur. Stocks were stronger. There are a lot of reasons why precious metal stocks should have gone down on Thursday and Friday, but they didn't. So it remains, longer term, remains highly bullish. If the US dollar strength continues, look, it's not going to be helpful for gold because there is an inverse relationship there, but it doesn't mean that the price of gold has to go down, because there's been times in the past when the two have risen together. So it's not a showstopper at all. But what it does mean is that your portfolio management is even more critical. And what I mean by that is how you get into precious metals stocks and how you manage them, take profit, and how you get out of them, and just manage the whole process. That becomes even more critical. I really can't highlight that enough. Before we go into copper, let's just take a look at gold and silver. There's the gold chart on a weekly basis, so you can see very slightly lower on a weekly chart. And there is silver. A couple of sharp moves down on Wednesday night and Thursday night in silver, and that's what I mean by the moves in the underlying stocks. That was a second sharp move in silver, and yet silver stocks did really well on Thursday night. Very interesting. This is GDX. You can see about a 6.5% decline on Wednesday night. We got a gap down open on Thursday, but then closed on its highs on Thursday, and then of course a little bit higher on Friday night. So incredibly impressive action. Copper was down a bit further, down to 208, and it's pretty hard to find positive signs around copper at the moment. It's forming lower lows, and that's really indicative of economic weakness. So it's certainly consistent with what we're seeing around the world. West Texas Intermediate crude continues to rise and is threatening $50, which logically seems incredible. But again, as I've been saying a lot over recent months, toss or don't let logic get in the way. Just go with what you're seeing unfold. And crude oil was higher to $48. If the US dollar rises, a lot of people are saying that it's a given that oil is going to get smashed. It's not necessarily the case. Just play it as it unfolds. There's the spot copper chart. You can see has now formed a new short and medium term low. So not a good sign for the global economy. Just to wrap it all up, the overall strategic approach. The first part of this slide is what I had last week because I just think it's the most appropriate message I could send at the moment. There's going to be a great deal of uncertainty through to the year end. We've got the possible exit of Britain. We've got the US elections and all the ramifications of whether Trump gets in or Clinton wins. And that's going to keep markets very, very nervous. And there's a lot of other things as well. As I said, there's China, there's Japan, there's other parts of Europe. There's a number of things. So what you've got to do is learn to ignore the short-term noise for two reasons. One is often it is just noise. It's not part of a trend. And secondly, that mainstream media generally get it wrong. So you don't want to be taking your cues from that source. But whilst you're ignoring the long-term noise, you can't afford to go to sleep. You've got to be responsive to the trend changes. That's not an easy balance to achieve. Precious metals are the strongest trend by far. There is some absolutely outstanding short-term and long-term entries unfolding. But as I indicated through the week, it's a very volatile market. It'll challenge your emotions and your discipline and your courage. It'll challenge it enormously. And unless you've been through this more than a few times and you really understand how markets work, it's not going to be an easy thing to make money from this if you're just out there on your own. So on that note, I'll wrap it up. Bit of a longer one this week, but just really, really important inflection points, I think, in markets at the moment. For anyone who's not a member, there's my contact details. Would love to hear from you. That's it for this week. Cheers.